Could one Roth conversion after 60 make more of your Social Security taxable and raise your future Medicare premiums? Stay with me. I'll show you how. A Roth conversion moves money from a traditional IRA or 401k into a Roth account. But here's the catch. The pre-tax amount you convert is generally added to your taxable income for that year. Convert $80,000, and your reported income can jump fast. That sudden jump in income can trigger the first surprise. If you're already collecting Social Security, the conversion can push your combined income high enough that more of your benefits become taxable. At the upper end, up to 85% of your Social Security benefits can be taxable, not an 85% tax rate. Here's how the Social Security calculation works. Take half of your annual Social Security benefits, then add your other income, including tax-exempt interest. That total determines whether part of your benefits becomes taxable. For married couples filing jointly, the first key threshold is $32,000. Now imagine a retired couple already close to that threshold. Their Social Security and other income put them near the line. Then they make one large Roth conversion. Nothing about their lifestyle changed, but on paper their income suddenly did. And that can make more of their Social Security taxable. That's why the size of the conversion matters. Converting a large amount in 1 year can create a much bigger tax hit than spreading conversions across several years. The goal isn't simply to convert as much as possible, it's to convert the right amount in the right year. And there's a second ripple effect many retirees miss: Medicare. A large Roth conversion can increase your modified adjusted gross income, or MAGI. Medicare generally looks back 2 years when determining whether you owe an income-related surcharge known as IRMAA. This is where the timing trap appears. A Roth conversion in 1 year can raise your Medicare premiums 2 years later, even though the conversion itself was a one-time event. So a tax decision you make today can show up as a higher monthly Medicare bill long after the conversion is finished. That's why looking only at your current tax bracket can be misleading. A Roth conversion may seem affordable on your tax return, but it can still create higher Medicare costs later. Before choosing the amount, you need to look at both systems together: taxes today and Medicare premiums 2 years down the road. One of the most important planning windows can come just before Medicare begins. Because IRMAA generally uses income from 2 years earlier, a large Roth conversion around age 63 can affect the Medicare premiums you face around age 65. That makes the years before Medicare especially important. That doesn't mean you should avoid Roth conversions before Medicare. It means you should size them carefully. A smaller conversion may keep you below an IRMAA threshold, while a larger one can push you into a higher premium tier. The key is knowing how much room you have before you cross the next line. There's another planning window to watch before required minimum distributions begin. Money left in a traditional IRA can eventually create taxable withdrawals you're required to take. A well-sized Roth conversion earlier can reduce that future balance. But again, the goal is not the biggest conversion. It's the most efficient one. So the real question isn't, should you do a Roth conversion? It's how much can you convert this year without creating a bigger problem later? Start with your income before the conversion. Then measure how much room you still have before reaching the tax bracket you're willing to use. After that, check Social Security taxation and Medicare IRMAA separately. The smallest remaining margin becomes your practical Roth conversion limit for that year. Let's make this concrete. Suppose a retired couple expects $85,000 of income before any conversion. If their planning ceiling is $120,000, they have roughly $35,000 of room. That doesn't automatically mean convert $35,000. Social Security and Medicare still need to be checked separately. Instead of asking how much you can convert, ask how much makes sense to convert this year. Sometimes using only part of the available room gives you a better result. because the taxable portion of a Roth conversion is generally included in income for the year you make it. Instead of asking how much you can convert, ask how much makes sense to convert this year. Sometimes using only part of the available room gives you a better result, because the taxable portion of a Roth conversion is generally included in income for the year you make it. This is why several smaller Roth conversions can sometimes work better than one large conversion. Instead of creating one big income spike, you may be able to spread the taxable income across multiple years and stay closer to the limits you planned for. The best year for a Roth conversion is often a year when your taxable income is temporarily lower. Maybe you've retired, but required distributions haven't started yet. That gap can create valuable room for a conversion, as long as you still check Social Security and Medicare before choosing the amount. One more mistake is forgetting the tax bill itself. A Roth conversion can increase your federal income tax for that year, so the tax payment needs to be planned in advance. In some cases, that may mean adjusting withholding or making estimated tax payments instead of being surprised at filing time. A Roth conversion plan should not be set once and forgotten. Your income, deductions, portfolio value, Social Security, and Medicare exposure can change from year to year. That means the right conversion amount this year may be completely different from the right amount next year. And don't forget the bigger picture. A Roth conversion is only one part of retirement planning. Your withdrawal strategy, Social Security timing, Medicare costs, taxes, and investment income all interact. A good conversion decision should improve the entire plan, not just reduce the balance in one account. Before you convert, run the decision through one final checklist. What will it do to this year's taxes? Could it make more of your Social Security taxable? Could it increase future Medicare premiums? And does the conversion still improve your long-term retirement plan after all of those effects are included? The biggest Roth conversion mistake is not converting too early or too late. It's converting an amount without checking what that extra income triggers. Taxes, Social Security, Medicare, and future withdrawals all matter. The right conversion is the one that fits your entire retirement picture. The takeaway is simple. Don't avoid Roth conversions after 60. Plan them. Choose the amount year by year. Watch the tax consequences, check Social Security and Medicare separately, and make sure the conversion improves your full retirement strategy. Before you make your next Roth conversion, don't just ask if you should convert. Ask how much fits your plan this year. If this helped you, subscribe for more retirement strategies built around real decisions.